Welcome to every golfer's favorite place, the 19th hole. Grab your transfusion and tune in as we talk about all things at the intersection of money, life, and golf. Hey everyone, welcome back. So today we're going to talk a little bit about market volatility and tax loss harvesting. So market volatility, no one likes it, but what are we or what are you supposed to do about it? The right answer is almost never changing your long-term investment strategy based on short-term volatility. That's historically a terrible idea. But one good idea, if you have taxable brokerage accounts, would be tax loss harvesting. Okay, so tax loss harvesting is never going to make you a millionaire, but it is a way to potentially create a small tax win during periods of market volatility. So what is tax loss harvesting and how does it work? How do you do it? To try and stay on brand here to the 19th hole, I'm going to tell a little golf story to explain what tax loss harvesting is. So let's assume that you, the golf junkie that you are, have more than one driver. Matter of fact, you have two similar but not identical drivers. So the same length, the same flex, the same loft, just one's a TaylorMade and the other's a Callaway. All right. So you go golf with your buddy, you start out the round with your TaylorMade, and you are just awful. Out of bounds, water, searching for balls everywhere on the front nine. Your buddy, sick of looking for your golf ball as you're making the turn, says, you know what? Go grab the Callaway. I'll give you $20 just to switch from the TaylorMade to the Callaway. Okay? You say, cool, $20, I'll do it. So you play the back nine with your Callaway. You are the same golfer, and you have essentially the same driver, still terrible. All right, on the back nine, more OB, more water, but at least you've got $20 in your pocket for making the switch. You have just tax loss harvested. Okay, so tax loss harvesting is switching from ETF A when it has a loss to a similar but not identical ETF B to book the tax loss. Okay, there's a lot of nuance and a lot of rules that going into this, but the cool thing with that loss is you can write off other gains for the rest of the year, or the real big win would be if you have up to 3,000 of net losses for the year through tax loss harvesting. You can actually write that off against taxable income for the year. Only up to 3,000, but for people at certain tax breaks, that can be a very real $1,000 plus tax win for the year, just for paying attention to this tax loss harvesting strategy during periods of volatility. So again, pay attention to how you're doing this, research it. There's a lot of nuance and rules, say the wash sale rule that comes into play here. But tax loss harvesting during periods of market volatility, a good way to put a little whipped cream on shit. You're not going to like the volatility, but maybe you can save a little bit on your tax bill at the end of the year. Hope this is helpful. If you have any topics that you want to hear about or any comments, leave them below. We'd love to talk about what matters to you. But until next time, see ya. Have a good one.